Hello everybody, it's March 22nd, 2015. We're almost through the first quarter of the year, and we had quite a rally last week off the Fed news. Seems like anytime the various central banks do their things, it's always good. It always leads to higher equity prices. Certainly it seems that way. Of course, we know that a lot of it has to do with how we're set up coming into those meetings, and in this particular case, we'd had this sell-off in front of it, and then of course they push it right back up. So broad rally, across all these indexes on the year. They're up pretty good on average. If we look inside what's happening here, I think we can pick out two or three things that look most interesting, I guess we should say, and that is that the Fed, of course, was the big news last week. We surged back up, we're at new highs, so forth, and you can see that across all these indexes. If we look at the S&P 500, it's pushing back up. We had quad witching on Friday, so you had a huge surge in volume. This certainly looks as if it will test the top, and as we'll get into here in a little bit, it looks like it has a bit more to go above that. But if you go across these indexes, all of them, NASDAQ composite new highs, NDX pushing up at the new highs again. The Russell definitely at new highs. This was the one we were chasing and didn't get into, and we'll talk about that a bit too, or at least we didn't get into on the portfolio. Hopefully you had a little flexibility and you were able to follow us what we were talking about on the TNT room there and get entries. These bullish ABCD structures, right? They don't have that much farther to go, and that's across all of these indexes. And so, let's take and look at what those structures look like. And maybe an easier way to do is first throw up this percentage-based, ABC projections that I keep in my spreadsheet. And one of these days we'll actually get this on the charts to make it nice and easy for everybody. But if you look at these, 2% on the Dow, 1%, 1.25% on the S&P, 2% roughly on the NASDAQ still, 2.5% on the NDX, and the Russell's already extended past where it wants to go. Now, if we take and look at the weeklies as well, the Russell has another 2% to go there, and then you get out into larger numbers on these others. Now, it looks to me like the strongest index is the one that's going to try to hit the weekly, whereas the rest of them are going to try to hit their dailies. And so if we think about it from that perspective, okay, so everything has about 1.5 to 2% to go. And you can look at these structures, if we look at the S&P 500, for example, you can draw these guys out. You had this initial push back down and back up, and so that push takes us up into that area. Since then, you actually had a double bottom basically as it came down, tested to the lows and just went back up. I don't see anything there. This is really the trade that's still in effect, and it's still in effect because it didn't violate anything. And I think I drew that right. I know some of these actually got lower lows. This one's 2041.88. Yeah, so this is actually one that did go lower lows. So actually the correct thing is from here down, right, and then back up. So we're still pushing. We're still trying to make those higher highs. This was the area. It's back over it. It's trying to go up and hit those targets up here. Those targets are not that high up. And so if I look at across any of these indexes, and we're looking 1.5, 2%, maybe 2.5%, that tells me just off the bat, hey, I don't expect this leg to go all that far, and that's probably the main thing to take away from today. I don't expect them to go all that far. That means whatever inventory you have, you're going to want to push some of it back out again. Earnings come up in 3 weeks, so there's plenty of time for this thing to reach those targets. Of course, those targets are not that far, so I don't think the timing has that much to do with it. The issue is going to be is how those pre-earnings releases, right, take place. In other words, we saw Intel, for example, just I guess it was last week, and we can pull it up and look at it. You know, they announced that they had earnings expectation that was on this day, so it was the prior week. And you can see they can't get going. They're going to come up here, test this top and fail, and they're just going to hold down here, and they're going to get ready to break this 30 number if the earnings turn out to be even worse. This is the concern, right? When I look across everything that's happening, the concern is that we end up with a situation where over the next 2 to 3 weeks before earnings actually come out, we start seeing these markets sell off into that news as a result of the pre-earnings warnings that are coming out. And I'll give you some numbers here in a minute, but these so far are not looking good. The dollar's range trading, that's actually a good thing for these markets, and I got some data from one of the members over in Australia. I didn't prepare it here to share with you, but essentially it said, hey, you know, not that much of the earnings really are affected by the dollar. And I don't disagree with that. It's that we don't have that much growth to begin with. And so anytime a company wants to build their books back up, remember we talk about their slop in the accounting books? There always is, right? You can move numbers around. How in the world can earnings always come, you know, a penny over, right? We're talking about billions of dollars. How can the earnings per share end up at exactly on the number or a penny over? Folks, they engineer them. I mean, come on. They engineer those numbers. They make them come out right where they're supposed to be. And they telegraph that, you know, to all the analysts, so the analysts create those expectations to be exactly what they need to be. This game is rigged, you know, when you think about some of these aspects of it. I mean, it's not like this stuff is magic. Oh my God, they just happen to hit the earnings number on billions of dollars of earnings or revenues. They hit it almost to the penny. That's because the numbers, you know, I mean, if you've ever done accounting books for anything yourself, you know how you can, you know, jigger the numbers around so that they come out about where you want them to. The dollar is an excuse for these companies to jigger the earnings around, right? Use the excuse to set up their books to give them some cushion going forward. That's how they do this, and that's what they're doing, and that's why the dollar strength is an issue versus, you know, the reality that it's not that much in terms of the earnings, right? I mean, that effect. I mean, yes, there are some companies that definitely are going to get affected, but a lot of it is an excuse. And so I just, you know, I want to make that clear. That's the way I see the world. I believe that's the way the world actually operates. Here's the dollar. That big spike down on the Fed. This is a daily chart. 25.77. On Friday, it went down and tested it again, got underneath it. 5.9, 5.9, about the same volume. What you're asking yourself here is not, is the dollar going to just croak and come all the way back down? That's not the issue. The issue is, where's the range? Is the range here, where it's already traded now, 2 big bars, or is it going to come all the way back down and make a larger one? And I don't know the answer to that. I mean, it could even come all the way down to here. Because if you take and divide this up now and say, okay, we've got a, oops, let me grab that again. We've got a range here, right, that's known. And if you just project that down, that takes you back into this area, which is where all the support is. And certainly it can trade back here. Will it? I don't know, because it's been so strong for so long. I don't know if it's going to come back there or not. We just have to watch it. What we saw Friday was it definitely still can, given the volumes, right? Because a lot of people pushed those trades back out. I expect that this volatility that we see here is going to continue to bleed into these markets, and I'm talking about all the markets, and create more volatility going forward. I think that's probably the main thing to take away. Whether this dollar trades lower or not, we'll have to see. I suspect it's a range, no matter whether the range is just up here or it's broader, right, this whole area. So that's the dollar, and that's what's happening there. If we look at the oil, that's the other piece of all of this, and that's tied to the dollar. Oil was set up to break on multiple time frames. You had this time frame here, right, and it was trying to break it, and did break it. Matter of fact, you can see it here on that. But it got back over it, and what it did when it got back over it is it did a retest regen off that low. Yet so far it has been unable to get over that and actually break that regeneration lower. So at this point, oil still, the jury's out on it. The top on that big spike on the Fed was 10.02. If we look at it on the Friday, it was 10.06. So you go over it, back under it, you close under it, you have less volume. That looks like it's going to still try to regenerate lower. If I pull up the USO, which is another way of looking at it in terms of an ETF, 1678, got to 1680, closes underneath it, again, looks like a failure. So far, oil itself looks like it's going to try to regenerate lower. But what it did not do is it did not break on the weekly time frame. Let me pull that up. And we look at it here, and I've got the USO. When we look at it there, that low was 1630, and we got to 1643 close, definitely underneath it. Volume just a little bit heavier, which says, hey, it's going to try to test it again. If I look at OIL and use it, you got the same situation. So oil looks like it's certainly not out of the woods yet. It did save itself from a larger decline so far by holding. So this next week, the point of showing this is this next week is going to be a big week in this market. And that's probably going to depend a lot on what the dollar does. But of course, it's also going to depend on the fact that oil has huge inventories. They've got a big mess going on in terms of they've got a place to store what they're pumping. And so there's this thing is culminating in either a collapse, another 30-40%, or it's going to build out some sort of a range with a very long, jagged, kind of sideways move. The reason it's important, of course, is that if this thing starts to collapse, it's going to do the same thing when it collapses back here, and it's going to put a lot of pressure on the markets. So that's why I believe it's something that we should be looking at and watching to see how it behaves in the coming week. If we look at the negatives, right, the negatives, going back to the thoughts here, the negatives are that we don't have that much far to go on these extensions on the ABCD structures or the ranges to the top side, and this increase in the volatility of the dollar is going to continue to be a problem. I could have put in here, and I didn't, probably should, and that is that oil potentially could crater, and if it does, that's going to be an issue. If we look at the positives, right, those bullish retest generates, they did regenerate, and they regenerated higher. So if I come back to the chart, so if we pull up and put this back on a daily and pull up, let's pull up like the NDX, for example, which is a good example of it. Here we had, let me grab this. Here we had a prior swing point high, came into it, tested into it, held, regenerated higher. It did it here. It also did it on the weekly. If we look at the weekly, we have that here. You can see on the weekly, that was up in this area. So it came back, tested into it, held, regenerated higher. Those are all positives, right? And those are good things. And that happened not only here, but it happened in a number of them. Fundamentally, world is stuck with ZERP and the QE policies. I mean, that's got to be the biggest positive out there. And that is because, central banks keep pumping these markets. And at some point, it's not going to work anymore. But right now, it continues to be the most dominating feature in the landscape on a fundamental perspective. The negatives, I was mentioning this earlier, for every company that's pre-announcing above, 5.5 of them are pre-announcing negative, just like Intel did. And so that's telling you this earnings season is going to be kind of tough in terms of hitting numbers. Not so much hitting the numbers because, again, they're engineering it the way they want it so that they can quote-unquote beat when it comes out. It's just that those earnings per share really are going to be lower, and that's a big issue. It's going to continue to weigh on the market. What do we watch for this next week? I think the things that we really need to look at, there's three. Do we hit those targets, those 1.5%, 2%, and then start to pull back? In other words, we get up there, hit them, and that's it. If so, then the expectation that I have is that, in fact, when we hit them, we will do that. If so, we really need to sell into that strength. Does the volatility continue to increase? In other words, is that dollar going to really start to the volatility really start to take off and continue? Does the oil market start to crater? Do we see that kind of action? If so, that also is going to be a big problem and create more volatility in the markets. And then this major double talk on the top on the NASDAQ, I'm sure we're going to start hearing about that a lot more. Let me show you what I'm talking about. So if you remember back in 2000, right, we had that ridiculous run from 92 or 93, I think it was. Matter of fact, we can look back. Started back in 91, right at the end. And this was the Gulf War, if you remember Kuwait and everything. That was when things, took off, right? And that was 91, and it ran, and then it escalated at the end, right? And finally did a blow off at the top. The top was 51, 32, 52. Well, here we are again. We're within like 100 points almost. And there's no way you're going to come all this way without touching that top and testing it. And I'm almost certain when you touch it and you test it, that's going to be the headlines everywhere, and the market's probably going to pull back off of it. That's not that far away. We're talking 2%. That also figures into what we were talking about here when we say, hey, these structures only have this far to go. If we look back again at that NASDAQ number and say, okay, what is the number on it? 51, 38, 82. 51, 38, 82. What's this top? 51, 32. It's going to go grab it. That's what it wants to do. And when it does, you need to liquidate some of your inventory because it's almost certainly going to pull back off of it. So that's going to be the news probably this week, next week, whenever it gets close enough. And that's going to dominate the news for a while. And it's going to be such a fixture as a result of it. So it's almost like, if you remember back, I don't know if you remember, but it was Dow 10,000, right? It was the party hats and everything. And it must have crossed 10,000 back and forth, I don't know, 20 times. It's going to do the same thing here. It is not that big number, psychologically, it's going to be a big number. And when we get there, it's going to stop stuff. And so I suspect that's going to be a big deal. So let's go back down here. So that's the things that are coming up. I think those are the things to watch. Upcoming earnings, we just had the Fed meeting, so what do? Everybody hits the road and starts talking. It's been that way for I don't know how long. I guess it will continue forever. They'll all say, what they want to say. One will say it's great, that we're going to keep things at ZERP forever. Another one's going to tell you we got to raise rates now, and it's just going to create more volatility like it always does. So that is one big piece this week, and they're every day. There's one or more speakers every day. Then we've also got more data than I actually thought we did. You can look it over. So the data is kind of heavy this week compared to what I thought it was when I glanced at it on Friday. Bottom line, I think the volatility up and down is going to continue. And what I'm talking about is that if I go back to the charts here and bring something back up, let me bring up a daily chart. And I can use this chart or any of them. But they all had the same thing, and that is that when they start to consolidate, right, after some sort of a large move, right, you get a lot of volatility. Well, we just had the breakout, and I suspect we're going to get a lot of volatility again. And that tells me I do not expect, and if I'm wrong, it's going to tell me this market's a lot stronger than I think. I do not expect this to lag higher and just keep going. I expect it to be a lot of volatility. And if it's true, and I'm fairly confident that this is probably what we're going to see for a while, then we have to try to buy here and sell there. And we have to try to focus on what those ranges are. with an upward bias. And so in other words, we don't want to try to short so much, but we do want to try to buy. If good shorting opportunities set up, we probably should take it. But for the most part, the ideal here is to try to buy retraces on these moves. And you know, when it's first setting it up, like it is here, right? When first setting it up, I probably should have been more aggressive and just bought down here, and I didn't. But you know, as I told you then, it wasn't clear to me with the Fed coming up whether that Fed would be bought or sold. We could have just as easily seen, you know, the spike up to the Fed and then the ABCD structure to take us back down here. Didn't work out that way. The ranges really did hold, and we got to push up despite the divergence that we see in the various issues. So we didn't catch this one. Well, we just got to catch the next one, and I suspect the next one is after a new high, we get some sort of retrace, and we'll try to buy the next one. We'll try to sell into this new high. So I expect that volatility. The other thing is that we've got divergent markets now. You know, if you look at the S&P 500, here's the NDX, and matter of fact, let's look at the others that have already broken out. Oops, let me put the right symbol in. So if we look at the Russell, we've already got the breakout. If we look at the composite, you know, the IXIC, we've already got the breakout. Then you go over and you look at the weaker ones like the Dow or the S&P 500, right? These guys have not broken out, and I suspect they're barely going to break out and just get over the highs, and that's going to be about it. That's divergent markets. In other words, you've got strength in one part of the market and you've got weakness in the other, and that rotation that we were looking for 2 to 3 weeks ago to keep us going higher did not happen. That tells me that this market's going to chop. And when I go back to that ideal of, hey, we're going to see this market, you know, do a lot of this stuff, you know, versus just going up, that's what I'm talking about. And this is just an indication that that's probably going to be the case. Divergent markets typically chop around. They don't stretch one way or the other until they're no longer divergent. And so I don't see that divergence ending yet. And as a result of that, I expect these markets to chop around. Portfolios. I want to talk about the trade that we tried to make, and I'm going to bring this chart up so that I can look inside. And I'm going to look at the IWM since that was the trade we were working on the Fed day. Bring this in 5 days. And actually this is going to give us a bad print, unfortunately, but we'll ignore this particular print. This was the Fed day. Matter of fact, let's just bring it into the Fed day and ignore the bad print. What I was looking for, if you go back and look at the order that we had in on the IWM, I wanted this market to prove it was going to go higher. And if you remember, I put an order, and I think the trigger was about 124.29. The ideal was that if it could break above these highs and get far enough, it would give me enough confidence that we actually were going to go higher, not lower. And then I put a stop limit that says, hey, trigger up here. It was at 29, I believe it was, right here. Trigger up here, and once it triggers, right, then try to buy it back cheaper. You know, in other words, catch that retrace, because that's probably going to be a surge retrace, because that's typically what happens on the Fed. We had that order, if I remember, it was at 124.03 or something like that. We got to 124.08. Now in the TNT room, if you know, and I encourage you on big days like this, check in if you have the opportunity, because in the room we had traded, because of the way this had traded early in the morning, we could tell on this surge that this thing was probably going to go higher because it already came a long way. The surge we were looking for was the surge off the Fed. I'm going to pull this in even tighter. We were looking for the surge off of this, coming from where? Coming from this level, the 123.60.70. In other words, that would have surged up and then back down and gave us an entry. It didn't work that way. And we came from a much lower, surged very high, well, actually surged here, consolidated, then surged, and so we didn't get the entry. You can't know all those things a priori. You know how difficult it is. If you have the flexibility, I encourage you, to look in on what we're doing, because of course those entries turned out to be really good entries, You know, 124, I think we took it at 11 or 13 individually, you know, in the TNT room. Now we're at 126. I'm not trying to make excuses. I'm just saying, if you have the opportunity, do look at what we're doing intraday on a big day like that, because, you know, I may have to adjust things based on what I'm seeing and based on what the prelude was prior to the actual news hitting. So anyway, we did miss the entry on the portfolio. We don't have it. Tried to get into the Qs on the next day. They didn't retrace enough, and I finally just bought them, as you know, on Friday. So I think we got about another 1.5%, 2% to go here on the Qs. We want to sell into the rally. Facebook actually broke out. Started to get a nice trade here. Let me get Facebook up. If we look at Facebook, so this was breaking out. I'd looked at this before, if you remember, and I think one of the members even commented to me, I'm put it on a weekly, commented to me that he doesn't see what I see on this particular issue. He was saying it just looks like a range trade. Well, Facebook comes out and they're entering the payments, you know, payment system, kind of replacing Western Union, maybe eating into eBay a little bit, and they got their breakout. They got a nice big move, volume picks up, and they finally got their breakout. And you know, the take here, in my opinion, is, you know, eBay wants to move higher. It's coming out of a range, a consolidation range, wants to move higher. The problem is going to be, just like the problem with everything, is can this thing extend if the market doesn't? In other words, can we get up here and hit the targets even if the market doesn't want to extend itself? That's something we'll just have to watch. If this thing gets choppy and can't move higher, and if I pull this back to a daily now, if it gets choppy and can't move higher, in other words, you know, we consolidate a little bit here and can't push higher, then we have to take some off and try to buy some cheaper and just trade around it with the ideal of staying in it. The same thing on eBay, and this is what I'm referring to. Now, eBay actually was hit because of Facebook, comes down, we got another entry on it. This should have just gone higher, and the news preempted it and didn't allow it. In other words, we got a breakout, we didn't get the continued push, and now we're kind of chopping around. Actually, I need eBay, not GSP. Hang on a second, let me get the right symbol up. Yeah, here we go. So we got the breakout on multiple time frames, and we came back and do an immediate retest regen. This looks like it's going to chop around. That says, hey, you have to go look at this and think about trading around the trades, right? Trade around it instead of just assume it's going to go higher, because it didn't do what it was supposed to do. And that's the way I always try to look at things. You know, that's the way I do, you know, make these trades. It's like, okay, what did it do? What did I expect it to do? If it does what I expect, then I want to stay with it and get stronger. If it doesn't, then I want to trade around it at worst, you know, at best, or potentially leave it at worst. Right now, I think the jury's still out on eBay. I think we need to stay with it, but I think we have to trade around it, and you'll see that in the portfolio. All right, that's kind of a long take here. I'm going to drop it at that. Market's going to be tough this year, folks. We're going to have to be careful about how we trade and what we trade. We're up good on the year. We don't want to lose what we got. If you've been a little flexible, you're probably even up better than a portfolio. Personally, you know, I'm up even better than that because I trade more often. Choppy markets tend to be good for me versus, you know, directional markets. I don't tend to do as well because I tend to take profits into strength, and a lot of times they're too premature. But you know, I'm going to leave you with one last thought, and this isn't a prediction. It's just an observation. In the 2007-2008 period, we had certain sectors that began to crumble long before the market did, a year before it. Financials, housing markets in particular, those two markets started to give it up in 2007, made their highs in 2007. When the overall market waited until 2000, well, that's not quite true. The overall market still was doing well while these were cratering a year earlier, or began to crater a year earlier. This time period, we see oil, we see materials struggling, in particular oil energy markets. It's not enough because they're not big enough, right? They're not a big enough part of this market to bring this market down yet. But if they continue to crater, especially if oil really begins to drop, you're going to see the rest of this market extremely, do an extreme struggle and potentially have that larger retrace that we so far have failed to get. That's the danger, and that's what we really have to keep our eyes on this year. Because if that starts to take place, you do not want to be long in this market. You don't want to see a 10, 15, 20% drop in your portfolio. You don't give back your gains. Managers who make money over time do not give back huge amounts of money in down markets. That's how they outperform. My portfolio performance since 2008, the fact that I did not give back 40% of my money, as a matter of fact, I made money in 2008, that's the difference, right? If you avoid the huge drawdowns, and I'm not saying we're going to get that kind of drawdown, matter of fact, I don't think we will. I think we can get 15%, maybe 20%. If you can avoid that, you will definitely outperform over time. And that's the key to outperformance. Not outperforming on the upside. You outperform when the market takes a hit. You don't give it back. Folks, have a great one. Thanks for joining me. I'll see you next time. Oh, this week, let me remind you, this week I'm out, and I'll put it in the emails tomorrow morning. I'm out Tuesday through Friday. I will do my best, if time permits and if I have access to the internet, to post trades, so forth. I definitely will post, I just want to have as extensive a comments as usual. I'll try to keep the portfolio up to date, of course, and I'll post what notes I can, but I will be pretty much out of it and not nearly as close to the market as I typically am, so be aware of that. All right, take care, thanks. I'll see you next time. Bye.